It's time for another Friday update on the Canadian housing market. There was a whole lot of data released this week, so this is going to be a math and stats heavy one, so I apologize in advance to all of you non-nerds out there. First up, the Canadian Real Estate Association released their national housing market data for October on Wednesday. Sales fell 5.6% month over month, but were up 0.9% from October of last year. The home price index also dropped 0.8% from the previous month. They note that this is still a 1.1% increase from last year, but keep in mind that inflation over the past year was 3.8%, so that's still a decline in real value. Personally, I think the distinction between nominal and real dollars and the fact that most people don't really understand it is going to play a significant role in how market sentiment and pricing plays out over the next few years. It's also worth noting that while we've seen a 1.1% increase in the home price index over the past 12 months, we've seen about a 3.9% drop over the past 4 months, with prices dropping every month. Looking at the home price index chart, we can see that we're dealing with market changes that are occurring on a timescale that's shorter than a year, so it's a good idea to be cautious about how you interpret year-over-year results right now. Just for reference, we're currently about 14.6% down from the peak in March of 2022, which is almost a 20% drop in real value when adjusted for inflation. On top of that, the sales to new listings ratio dropped to 49.5%, a 10-year low. This means that for every home being sold, about 2 new listings are coming onto the market. Again, this doesn't indicate that prices are about to crash, but it does mean that selling a home is becoming more difficult, as buyers don't seem to want to pay what most sellers are asking. Next up, the CMHC has published the fall update for their residential mortgage industry report, and there's a few interesting trends that are continuing to emerge. First, while variable rate mortgages are still much less popular than they were a couple of years ago, we're starting to see more people taking on 5-year fixed mortgages with a decline in 1-year and 3-year fixed terms. It's hard to say for sure, but it may be that people are starting to give up on the idea of rates falling quickly over the next couple of years and are preferring to opt for the certainty of a longer fixed term. On the other hand, it could just be that banks are currently offering lower rates on 5-year fixed terms than they are on shorter terms in anticipation of coming rate cuts. In general, though, the consensus seems to be that rates will stay higher for longer, and we may not see a return to the near-zero rates that we've seen in recent years. We're also seeing a slight uptick in mortgage delinquency rates, particularly on higher-value mortgages. However, the overall delinquency rate still remains low at about 0.15%. Personally, I don't consider this to be a very important indicator of the direction of the market because for many Canadians, their personal residence is the bedrock of their lifestyle and finances, so the mortgage is the last type of debt they'll be willing to default on. We are seeing increasing delinquencies on other credit products such as auto loans, credit cards, and lines of credit. On top of that, we're seeing non-bank lenders such as mortgage investment corporations and other private lenders increasing their market share of residential mortgages. This is generally not seen as a good sign because usually these lenders are used by borrowers who don't qualify with chartered banks at first but are hoping to move to an A lender as they build up more equity. Instead, we're seeing the opposite trend right now. People are moving away from A lenders and switching to B lenders as they struggle to make their payments at higher interest rates. We're also seeing an increase in the risk profile of mortgage investment entities, which also tend to have a significantly higher delinquency rate than other types of lenders. It's a lot of data, but it all adds up to what we already knew. People are struggling to make their payments, and they're trying to find solutions to stay in their homes. However, based on the data for mortgages and other forms of consumer debt, it seems like the situation is getting worse rather than better. Finally, in a blow to the housing supply, there are a large number of condo projects being shelved in the GTA due to low sales of new-built units. Urbanation reports that 40 condo projects totaling 13,721 units, which were expected to be available this year, have been put on hold. New condo sales in the GTA this year are the lowest in a decade, and with interest rates for construction projects rising with everything else, and the price per square foot of new condos declining 18% year over year, we're seeing more builders taking a wait-and-see approach on their new build projects. That's all for this week. I know I was late this time, but it's still Friday, so whatever. Thanks for watching, and enjoy your weekend.